Hi there, welcome to the module on double entry accounting. In this module, we will cover the following topics: some important accounting terms, introduction to double entry accounting, classification of accounts, and journalizing transactions and preparing ledger accounts in the books of accounts. Now, in order to understand how double entry works in practice, it is important to first understand some of the terms that are commonly used in accounting. The first term is assets. Assets are what a business owns. These are resources used by the business to generate revenue in the current and future years. So, some examples of assets are buildings, land, machinery, cash, stock, etc. Assets can be further classified into current and non-current assets. Assets that can be quickly converted to cash within a period of 12 months are classified as current assets, and the rest is non-current assets. Liabilities, on the other hand, are what a business owes or its obligations. Liabilities can be described as amounts owed by a business to other business entities or individuals. Some examples could be creditors, that is the amount owed to suppliers, bank loans, salary not yet paid to employees, etc. Liabilities are also classified into current and non-current liabilities depending on how soon these liabilities or obligations need to be paid off. So, current liabilities are liabilities that have to be paid off within a period of 1 year. Capital represents the money invested by the owner or shareholders of the business. Capital includes all capital investments plus any undistributed profits. Revenue is also called sales or income. Revenue represents the proceeds from the products and services sold by the business. It also includes any profits or gains from secondary activities such as interest on investments, bank deposits, any profit on sale of any fixed asset, etc. Expenses are costs incurred by a business to generate revenue. So, the costs incurred include raw material cost, salaries paid to employees, office rent, factory rent, office lighting, etc. It's important to remember 2 points. Assets, liabilities and capital will always be reported in the balance sheet, while revenue and expenses would be reported in the trading and profit and loss account. In this module, we are going to understand how double entry accounting works, how transactions are recorded in the books of accounts by way of journal entries, and how these journal entries are updated in the ledger accounts. As you might recall from an earlier video, I had explained dual aspect accounting. In accounting, every transaction has at least 2 effects and will affect at least 2 accounts. Think of a situation where a company, say A Limited, buys new machinery from another company B Limited by paying cash. Now, please make a note of this example as we will refer to this example several times during the course of this video. In the books of A Limited, purchase of this new machinery will increase the value of total machinery owned by A Limited. Now, this transaction will, however, reduce the cash balance as A Limited has to make a cash payment to B Limited for the machinery purchased. B Limited, on the other hand, will see a decline in the value of machinery owned by it and a corresponding increase in the cash balance as it receives money from A Limited. Hence, every financial transaction involves simultaneous receiving and giving of some monetary value and will impact at least two accounts in the books of accounts. In my example, the two accounts that are affected are cash account and machinery account. So, this is the foundation of double entry accounting. The two effects in double entry accounting are known as debit and credit. For every debit entry recorded, there has to be an equal and corresponding credit. All transactions and events that occur need to be recorded and properly classified in the books of accounts. Now, this classification can be done by following the traditional approach or the modern approach. In the traditional approach, accounts may be classified into three broad categories: personal accounts, real accounts and nominal accounts. Personal accounts are the accounts of other business entities or individuals. In the example that I mentioned earlier, the account of B Limited in the books of A Limited would be a personal account. Personal accounts would be accounts of debtors, creditors and other individuals or companies that the business transacts with. Real accounts are accounts that represent assets, both tangible and intangible. Tangible real accounts are cash, building, land, stock, that is assets that can be seen or touched, while intangible real asset accounts could be goodwill. The third category is what is known as nominal accounts. These accounts represent revenue, expenses, gains and losses of the company. Now, let us understand the accounting rules to be followed under traditional approach. These rules are popularly known as the golden rules of accounting. And the rules are: for personal accounts, you have to always debit the receiver and credit the giver. For real accounts, the rule is to debit what comes into the business and credit what goes out of the business. So, in our earlier example, A Limited would debit machinery account as it receives machinery from the supplier, and it would credit cash account as cash goes out of the business. For nominal accounts, the rule is to debit all expenses and losses and credit all revenues and gains. Now, under the modern approach, the first rule for classification of accounts is that all assets, expenses, losses related accounts will by default have debit balances. All liabilities, capital, revenue and gain accounts will have credit balances. So, accounts such as cash, buildings, salaries etc. will have debit balance, while accounts such as creditors, bank loan, capital etc. will have credit balance. Transactions are recorded on either the debit side or the credit side in a journal entry according to the rules mentioned that you see on your screen. Any transaction that leads to an increase in an asset has to be debited. On the other hand, a transaction that leads to a reduction in the value of an asset has to be credited. So, in the example that we discussed earlier of A Limited and B Limited, when A Limited purchased the machinery by paying cash, it would debit machinery account as there is an increase in value of machinery post the transaction, and credit cash account as there is a reduction in the cash balance once the payment is made to B Limited. The treatment for expenses and losses is similar to the treatment for assets, This is because all of these accounts have debit balances. The treatment is exactly the opposite for liability, capital and revenue accounts. Here are some examples of transactions that would need to be debited while preparing journal entries. So, transactions that lead to increase in assets such as purchase of machinery or cash invested by owner in the business have to be debited. Transactions that cause decrease in liabilities, for example, payment to creditors or repayment of bank loan, also need to be debited. Transactions that lead to increase in expenses or losses such as salaries paid to employees, rent paid to the landlord or any loss on sale of machinery have to be debited while preparing journal entries. Transactions that cause decrease in revenue, for example sales returns, has to be debited at the time of preparing journal entries. Let us now look at some examples of transactions that would need to be credited while preparing journal entries. Transactions that lead to increase in liabilities and capital, for example unpaid salaries of employees or credit purchase from a supplier or new bank loans taken have to be credited. Transactions that cause decrease in assets such as sale of fixed asset or decrease in cash balance also need to be credited. Transactions that lead to increase in income or gain such as profit on sale of fixed assets or sale of products or services also need to be credited.